Okay, section two of day two's lecture here. Let's talk a little bit about the regulation of the financial system, right? So as we talked about here in section one, with credit rationing creates a big role for government, right? In regulating the financial system, trying to provide better information. Let's talk a little bit more specifically about what governments are supposed to do, and then we'll talk a little bit about the US system of financial regulation. First off, financial markets are not perfectly competitive, right? If you ever hear a politician talking about let the free market reign when you talk about financial systems, you know that they're full of shit, right? Because financial markets are not perfectly competitive. The free market is not a stable or efficient market. And largely, this is because of asymmetric information, right? Risk. Risk is what makes the financial markets different from the market by buying and selling oranges, right? That there is a fundamental difference in risk that puts finance at danger, right? It puts it at danger. And so governments have a role in trying to regulate financial systems in an effort to try to reduce risk. And the goal here is if you reduce risk, then you encourage more finance. And of course, more finance leads to more economic development, and it leads to a better society. So that's the fundamental rationale for why governments need to be involved in financial systems. So there's really kind of, I would say, two basic ways that the government needs to be involved in regulating the financial system, right? Let me flip up my notes here. So the first principal aim of financial regulation is just simply to increase information. So governments have a role in making sure that the public has information about any sort of financial institution, right? In fact, this is really the only way that financial markets are regulated, right? Bonds and stock markets are not highly regulated by the government. The only regulations that they have really all concern information to make sure that there's enough public information for people to make reasonably informed decisions about the stocks and the bonds that they buy. Other than that, it's caveat emptor, right? Which is Latin for buyer beware, right? So if you buy a share of a stock and it goes in the toilet, right? Can you sue that company? In general, no, unless you can prove that that company issued fraudulent information. Just issuing bad information is not even enough, right? It has to be purposefully incorrect. If it is incorrect, but not purposefully, you can't sue, right? So, those of you who have any money in the stock market, you might feel like, you want to sue the companies who've seen their stock go in the tank and have lost you a lot of money here in the last couple of months. But those lawsuits aren't going to get anywhere, right? Because as long as companies did not provide fraudulent information, they're okay. They're okay. This is the role of the Securities and Exchange Commission in the United States. Basically, the Securities and Exchange Commission is charged with enforcing information disclosure standards and also to prevent insider trading. So in other words, make sure that people do not trade on information that is not publicly known. And in fact, the Securities and Exchange Commission, of these two jobs, has really increasingly seen the second one as something that is prosecuted more and more, preventing insiders from trading on information that is not publicly held. I think there's good reason to think the Securities and Exchange Commission is not doing such a good job on the first one, making sure that all publicly held companies are providing the kind of information that they are required to by law. And we'll talk more about that as we go along. The second big role of government in regulation is to regulate banks. So while financial markets, meaning bonds and stock markets, are really regulated only in terms of disclosing information, banks face a lot more regulation, right? A lot more in terms of quantity and a lot more in terms of variety of regulation. Banks have regulations on who can own them, They have information reporting requirements. Banks have to follow loan safety standards, meaning banks can't just give you a loan to go play at a casino, right? Banks can only legally make certain kinds of loans that have tight risk standards associated with them. Banks also have to qualify for deposit insurance from the Savings and Loan, the FDIC, which is the Federal Deposit Insurance Corporation, and the FSLIC, which is the equivalent for savings and loans. One of the interesting things that we'll talk about is banks, of course, can be victims of asymmetric information, and they can be victims of moral hazard when they give somebody a loan and that person does something very risky with it. But banks can also engage in moral hazard because banks are not just lending, banks also borrow, right? When you put a deposit in a bank is borrowing money from you. And so banks have the same incentive to engage in moral hazard behavior. And so, so many of the regulations that are imposed by the government is trying to make sure that banks don't do too risky of things with your deposits. Banks also have to meet required reserve ratios. Required reserve ratio means that whenever a bank takes in a deposit, they have to keep a certain percentage of that deposit at the Federal Reserve. And hopefully you remember discussing required reserve ratios from Principles of Macro. And we'll talk more about how exactly these required reserve ratios work as we go along in the class. But yes, this is one of the obvious ways that banks are regulated. Finally, capital requirements, right? Banks have to keep a certain ratio of equity, right? And they cannot see that equity fall below a certain ratio. Why are banks required to have equity? It's simply a matter, once again, of making sure that they don't engage in too risky a behavior. We want the people who own banks to have some skin in the game, to have something to lose. And so stockholders have to put some money up for a bank to be allowed to run, right? So that somebody has some money to lose, right? If we had banks that did not have any equity, banks would essentially be borrowing and only using borrowed people's money to make decisions, right? The owners of the bank would have no skin in the game. They'd have nothing to lose if the bank went bankrupt. And so we want to make sure that shareholders have some skin in the game so that they have something to lose, so that they monitor what the bank is doing, right? Making sure that they don't engage in too risky a behavior. So those are the two big areas of regulation, financial regulation in the US. Information disclosure by the SEC, and then the regulation of banks in these multiple ways. One of the things that I want to be clear here is in the US, it doesn't make any difference whether it's a US bank like, if it's a US bank like the US Bank, right? Or if it's a US bank like Morgan Stanley, or if it's a foreign bank like Deutsche Bank. They all have to abide by exactly the same rules, right? So the origin or the nationality of the bank doesn't make any difference. They have to abide by all of the same rules in their behavior here in the United States. Regulation in the US, financial regulation, is pretty complex, much more complex than it is in most countries. And the reason is that, as we're going to talk about multiple times here over the course of this block, that there has always been a fear of centralized banking in the US, right? This fear of big banks and big banks becoming the tools of the powerful and exploiting those who are more vulnerable, right? And probably most of you have seen Hamilton, right? This is one of the fundamental discussions on which our country was born. To what extent do we want to have centralized, powerful economic forces, and then to what extent do we want to keep our economy decentralized? And so this conflict between centralized power and decentralized power has always been most evident when it comes to talking about financial systems. And so as a result, our financial system in the US has evolved in ways that that there's lots of overlapping responsibilities, complexity, confusion, and different regulators, right? Any bank might have, at least historically, might have 3 or 4 different regulators, whether it's a state regulator, a national regulator, a regulator for the Federal Deposit Insurance Corporation, the Fed, right? Many, many different kind of regulators. So it's a very complex system. That all changed in 2010 after the global financial crisis. The Dodd-Frank Financial Reform Act, which we'll talk about in more detail coming up, has now made the Federal Reserve the systematic regulator of the entire financial system. So the Fed now is the primary regulator of the entire system. But that doesn't mean that there's not other regulators that also play a role in this. And so if you look here, this is Table 5, which has the principal regulatory agencies of the U.S. financial system. You can see that we have 7 different regulators here that play some role in regulating the U.S. financial system. It's still a very complex system. You have the Securities and Exchange Commission, the Commodities Future Trading, which focuses more on futures and commodity markets, which we're not going to talk much about in this class. The Office of the Comptroller of the Currency, who regulated federally chartered banks. The National Credit Union Administration, that focuses on credit unions. State and local bank commissions that focus on regulating state banks. The Federal Deposit Insurance Corporation, right, that regulates any bank that takes deposit insurance. And then finally, the Federal Reserve, who now we can see here is the regulator of all depository institutions. The only one of these regulatory agencies that covers everybody. So while the Fed is most important, and we're going to talk about the job of the Federal Reserve in this, it's also important to know that this is really a complex and overlapping system, which largely comes about from our complex history of banking and finance here in the U.S. So we will talk more about that history and how that shaped our current financial system as we go along. So that ends section 2 of day 2's lecture. We'll pick up here in section 3 and talk a little bit about Michigan Chapter 3, What is Money?